Hello, welcome to Chapter 1 of Federal Income Tax this semester. This first chapter basically is, like it says, just an introduction to taxation. We'll go over a lot of concepts that we'll just briefly touch on in this intro, and then obviously we will dig deeper into those concepts as we move throughout the semester. So, I definitely would not say there should be, or I guess I should say there should not be a lot of stuff that you feel like you have to take notes on and like really digest from this chapter. I would just kind of watch it and listen to this lecture, read through the book chapter, and I don't want to say skim it per se, but then that's basically the level of understanding from this chapter that you're going to need to take away. So, as you can see from this slide, basically, the income tax from the federal standpoint is definitely not something that was outlined in the Constitution. The fact that it wasn't there is the basis for, you may have seen, or you probably will see, people that protest the income tax and say, hey, this is unconstitutional. Those people, by the way, usually end up in jail, but there are people that, from a strict reading of the Constitution, you could say this authority was never really outlined and set out in the Constitution as being something that the federal government should have. With that being said, you can see here the 16th Amendment in 1913 made federal taxation of individuals constitutional, and we all know what happened after that. Basically, taxes have more or less gone up ever since then. Here you can see just the proliferation of the federal income tax. In 1939, basically almost no one was taxed, and then you have 1974, which is more or less how things are today. More than 74% of the population is taxed. So obviously, under our current system, there are certain numbers of individuals who end up not owing any tax, which is fine, but just know that the vast majority of people will end up paying taxes. Obviously, taxes end up being the main source of revenue for our government. Here you see where the vast majority of federal government revenue comes from. Obviously, taxes make up a large portion of that, with the largest chunk coming from individual income taxes. Now, obviously, this pie chart is not really, the percentages are not equating to the size of the pie that is made up by these categories. Otherwise, individual income taxes would make up about 50% of the revenue sources, and then between individual income tax and Social Security taxes, which also come from individuals, you would see close to 80% of the total revenue source of our federal government coming from these individual entities. That is surprising to a lot of people, because a lot of people believe, hey, these big corporations, let's just tax them to get all of our tax money. But you can see here that even increasing corporate income tax by, say, 10%, that would really only have a 1% increase in overall revenue to the federal government. So the vast majority of money coming into the federal government is not coming in through corporate income tax. It is coming in through individuals and their paying of taxes, whether that be individual income tax or individual Social Security taxes, or Social Security taxes paid by companies on behalf of individuals. Your book will talk a little bit about some of these different tax rate structures. You've got progressive, regressive, and proportional. So progressive would be where you have a lower tax rate for individuals who earn less money, So you would say start with a 0% tax rate for someone who made, $5,000 or less, and then it would go up to, say, if you make over $2 million a year, you're up into I'm just making these numbers up, but you're up into, say, 40%. So that would be progressive. The percentage of your income that you pay towards tax goes up as the size of your income goes up. Regressive would just be the opposite of that. So as you make more and more money, you owe not necessarily less tax, but less percentage of your money would be taxed. And then proportional is basically what you see with people who advocate a flat tax, where no matter how much money you make, you will owe, say, 15% of that in federal income tax. Okay? And then you have also these other types of tax rate structures which are not necessarily independent of the previous ones we talked about. You could have a combination of those structures seen on this slide and those structures seen on this slide. But basically a marginal income tax structure is what we have in the United States. And this is basically you have different tax brackets where, say, everything you make from zero to your first $50,000, again, I'm making these numbers up just to prove the point here, but everything in that 0 to 50,000 category is taxed at a 5% rate, and then your 50,000 and first dollar that you make all the way up to your $75,000 that you've made. So everything from 50 to 75,000 is taxed at a 10% rate, and then everything from 75,001 all the way up to 150,000 is taxed at a 20% rate. So for each next dollar that you make, that dollar could be taxed at a different rate than the first $50,000 that you make. So you have basically these stair steps in a marginal structure where everything's taxed equally until you hit a certain number, and then you jump up a stair step to this higher tax rate. Average and effective tax rates are somewhat synonymous. Basically, average tax rate, you're just taking total tax paid divided by either total income or total taxable income, and that gives you some type of average. Now, effective tax rate is a type of average tax rate, and the way there's actually many different definitions for effective tax rate, but the way that most entities in the know would define effective tax rate would be total tax owed divided by taxable income. Okay, so even under a marginal system where different amounts of your money are taxed at different rates, you do have an overall total tax that you owe. If you divide that by total taxable income, that will give you your effective tax rate. So this is just a basic equation that will help you determine taxable income and tax due. This is a helpful slide to keep handy just so you can see the broad overview of how the system works. Obviously, we will go through each of these components in greater depth or in any depth at all later on in the course. Apart from federal income taxes, these are some other ways that different governmental entities, and some of these are federal taxes, but you have state and local taxes, estate taxes. You could have state estate taxes, federal estate taxes. You have gift taxes, property taxes at varying levels, federal excise tax. Sales taxes could be at different levels as well, local, regional, state level, employment taxes, unemployment taxes, federal, state level of those as well. This is supposedly the criteria for a tax structure, although many people, myself included, would argue that this is certainly not the way that our tax structure works. When you have 17,000 pages of tax guidelines, not to mention the individual court cases that serve to define these various tax guidelines, it's very hard to say that that's a simple or follows the simplicity component of this tax structure. Mitt Romney was in the news a lot when he was running for president, basically because his effective tax rate was so low, because he pays all this money to tax advisors and people that are very good at minimizing taxes paid. So it's very difficult to argue that it's an equitable system. Certainty, obviously, if you could hire different tax professionals that will end up calculating your taxes differently, it's hard to say that there's a lot of certainty in our system. Convenience is laughable. It's hard to even discuss that. So really, I would change this slide to say this is the criteria for an ideal tax structure. We have gone very far afoot from this type of tax structure in our country. But when changes to the tax structure are discussed, these are the components that are supposed to go into that. Again, I wouldn't say that these are necessarily what the actual objectives of federal income tax law are, but they usually will fall into these categories. More often than not, you'll see that second component, promoting certain activities, tends to trump most of the other ones. As with most stuff at the federal government level within the United States, there's a lot of stuff going on behind the scenes, and a lot of special interest groups and or lobbyists that end up swaying legislation that usually goes to promote some certain type of activity. We've also seen recently that even the IRS, which is supposed to enforce the tax laws, we've even seen that enforcement arm of the IRS used to promote certain political activities as well. So no arguing that the tax code and the system that's in place is a very powerful tool to promote certain activities. It's hard to say that that's necessarily done equitably, depending on who's in power. Obviously, there are social objectives of tax law. The way that our system is set up is supposed to have some social equity there. And then, obviously, new tax laws that are invoked are there to try to reform existing tax laws. These here are the entities involved in the federal tax system. So you basically have individuals and C corporations. Then over on this other side, you have these flow-through entities. And these are entities that may have to file certain paperwork and returns, but in the end, the money, the check that's actually cut to the federal government, comes out of the pockets of individuals or C corporations. That's why when you look back at that pie chart that we looked at in one of the first slides, you see individual tax revenue as one component of the pie and corporate tax revenue. And what they're really talking about is C corporation tax revenue as another component of that slide. Then with these other flow-through entities like the sole proprietorship, partnership, S-corp, LLC, which is limited liability company, or limited liability partnerships for LLPs, and trusts. These are entities that have some function in and of themselves, but what happens is the entity will have, certain income and perhaps even certain tax rights or responsibilities, but all of that income and tax responsibility or right may make a stop at the business entity level where it is recorded in some type of paperwork, but in the end, the actual fruits of that entity, the income, the tax liability flows through to the individual owners or recipients of that money. So the key component there is that it's not taxed per se at the business entity level, so you escape one of the bigger negatives of the C corporation, which is taxing both at the business entity level, and then as the money hits individual hands, it's taxed again. Of course, like I said before, we will touch on all of these components both in class more, in person, and also as we move further into the material for this year. This is just a quick little graphic to show you that a large portion of the total tax revenues comes from a less than equitable percentage of taxpayers. Now, depending on which camp you fall in, some people believe that if someone makes more money, they should have to pay a greater percentage of tax revenues. So there are some people that believe that way, and then some people that believe that someone who makes $10 billion is not necessarily using that much greater of a percentage of the public things that the public uses, or the government uses these tax monies to fund. So they say, okay, why should someone who makes that much more money pay that much greater of a percentage of the taxes if they're not receiving an equal amount of benefit there? So really what it usually ends up boiling down to is, do I have a lot of money? If so, then I probably don't want to, I'm probably in the group that says, no, the higher money-making individuals and entities shouldn't have to pay more. And if I have less money, I usually say, yes, those people should have to pay more. Because in the end, what it usually boils down to is no one wants to pay a lot for income tax. Again, this is just a flow chart of what tax calculation looks like for individuals. A real basic flow chart. This may have some value in the future just to give you a top-down or 20,000-foot view of tax calculations. Obviously, the devil is in the details, so calculating these individual exclusions, deductions, etc. are what most of tax computation boils down to. Again, another flow chart that just shows you what all goes into the gross income calculation. And this is basically any money that you earn. It can be simplified by saying, more or less, the government's going to want a piece of any money that you make, whether that is earned income, which would come from working a job or whatever, or an investment. This would be passive income. Or flow through. That means a business entity makes the money, but since you are a recipient or owner, have an ownership interest in that business, the money flows through to you. So basically, any way that you make money, generally, and I say generally because there are some exceptions to that, it will be included in your gross income. So I would err on the side of saying that pretty much anything you make will fall into this category. This is an important distinction of for versus from AGI, and AGI just is an abbreviation for adjusted gross income. And oftentimes in the business you will hear this being described as an above-the-line deduction or a below-the-line reduction or deduction. Okay, so AGI, or adjusted gross income, is what is called the line. So basically, above the line means before you calculate adjusted gross income, you take out these deductions or reductions, and so your adjusted gross income itself will be reduced because of these deductions. Below the line means you have already calculated your adjusted gross income, and then from that number, this is where the from comes from that AGI number, you are further reducing or deducting items from that number. And why this is important is there's a lot of calculations done within the tax code itself in calculating various things that use adjusted gross income as part of the calculation. So if you have deductions that reduce your adjusted gross income, that will have a large effect on various other components of calculating your tax down the line. So it is very important, and has generally deductions that occur above the line end up having a much larger effect on your overall tax situation, because they are then used in calculating some of these other calculations as we get down the line. And of course, you will see this in greater detail as we move through the course. Just want you to get that terminology in your head of for versus from AGI. Again, as was depicted in that pie chart before, C corporations account for a very small, in terms of the overall percentage of revenue, a very small percentage of U.S. tax revenues. So for this reason, it would take a very large percentage increase or decrease in corporate taxes to have a large effect on the overall revenue situation in the government. So, this concept goes a long way towards understanding what's actually going on with a lot of tax policy stuff, because knowing the overall relative value of a change in corporate tax structure will help you understand why, if someone says, hey, let's reduce overall individual income tax rates by 5% across the board, that's going to have a much more profound effect on the overall revenue of the federal government than, say, raising or let's say lowering corporate income tax by 10%. Okay, lowering corporate income tax by 10% would have an overall effect on federal revenues of about 1%, versus lowering 5%, the individual income tax across the board would have about a 2.5% effect on overall revenue of the federal government. So it's all relative, is what I'm trying to say there. Again, this slide talks a little bit about the double taxation of C corporations, where it's taxed at the business entity level and then again at the individual level. We will go over that in much greater depth as we move forward. Again, I'm not going to get into that too much there. Again, just talking about the double taxation. This is the calculation, a flowchart of calculation for tax computation for corporations. Do not be fooled by the fact that this flowchart looks less complicated than individual taxes. Corporate tax structure and overall corporate tax law is actually much more complicated than individual tax law for the most part. These are the various types of flow-through tax entities. I'm not, to be honest, I probably should have just deleted this slide. This does not really illustrate anything other than just setting out what some of the names of these entities are. This just describes more or less what a flow-through entity does. We will talk, if you take the second semester of federal income tax, we'll talk more about the purposes of these various flow-through entities and why you would want to maybe form a corporation, or rather than a corporation like an S-Corp or an LLC or an LLP, or one of these various other flow-through entities. What would be the tax benefit to that? What would be the law benefit of forming one of these entities? But for now, the big difference that you should know is flow-through entities are not double taxed. They're not taxed at the business entity level. The actual income is only taxed once it reaches the individual owner's hands. I'm not gonna dwell too much on calculating flow-through taxes, just because this calculation of partnership basis, this will form a large percentage or at least a decent percentage of what we talk about in income tax too. So just take what you will from the remaining slides in this session. Most of these, again, are just going very surface level of stuff that won't even be talked about this semester. Just to show you, illustrate some differences between individual income taxes and other business structures and their income taxes. Partnership formation, again, we'll talk about next semester. Everything you ever wanted to know about S corporations, next semester as well. LLCs, we'll talk about next semester. These all function similarly as far as the tax monies flowing through them to the individuals, but there are some different reasons legally why you would form these depending on what your business does, and each of them has their own types of restrictions that might make them less interesting or less valuable to you as a business entity to form. Okay, moving on. This is more relevant to our discussion this semester. These are the various areas where you will see tax law coming from. So the main areas are the top bullet points from each of these three sections. So you have Internal Revenue Code. This is the tax code. Okay, this is the most basic statutory language coming from Congress as to what is involved in the tax code. This is several thousand pages long just by itself. Then you have Treasury regulations, which come from the executive branch. So these are not coming from Congress. But again, this is probably 15,000 pages worth of different regulations that come from the executive branch, mostly coming from the Department of the Treasury, and these are considered tax law sources. And then on top of those statutory sources of tax law, in our system of our legal system, you have court decisions which will serve to interpret Internal Revenue Code and Treasury regulations. We won't get into the minutia of the revenue rulings, revenue procedures, PLRs, congressional committee reports, or judicial doctrines. If you were to take more in-depth courses in any type of income tax, you would get into some of that stuff. But the main sources of law will be the court decisions, Treasury regulations, and the Internal Revenue Code. So, under the Internal Revenue Code, this is the process by which a tax bill comes into existence and then would make up part of that Internal Revenue Code. You can work your way through this flow chart. I won't go into it in any great depth. This may be a handy tool to look at if we ever look at any individual bills that are interesting, that are making their way through Congress during the class period. Obviously, the fact that I told you in class that we have to get the newest version of the textbook each year is because tax law does change year to year. This is an area of law, probably the biggest area of law that changes the most year to year. So this is the process by which a tax bill goes through. You can see there are many places where a tax bill can end up dying. So it's very difficult for a tax bill to go through all of these basically different steps before it finally can become a law. Okay, this is, to some extent, because our system of government is set up in a way that is purposely inefficient. Basically, we don't want anything to come through as law that is not very well vetted before it gets there. The problem with that approach is each one of these different steps can serve, each one of these can make some changes to the bill as it comes through. The problem with that is when it finally gets approved, it ends up being very bloated, and there's very complicated bills that flow through the system and end up containing some components that many of these people that vote on it have not even read. This is what makes our system very complicated. Luckily for anyone who's studying this and considering going into the tax field, those complications are what provide job security for individuals working in the tax field. Now, with that being said, that societally is maybe not necessarily a good thing. I'll let you be the judge of that on your own. So this is the organization of the IRS, where the authority comes through the Treasury Department, and obviously that branches out and gets broader and broader as it comes down to the individual auditors. We will talk about this a little bit more as we go through, whether or not, the likelihood of an individual being audited. You can see here that 1% of tax returns are selected for audit based on these scores, and they're basically we'll look at the various deductions that you took. There are some red flag deductions that kind of trigger a more vigorous search into your tax return to determine whether you will be flagged for an audit. When audits come, they can come in the form of either a correspondence or letter audit. That will happen if the documents don't match based on documents submitted. If that's the case, they'll request basically an explanation from the taxpayer. Those are not the audits that most people fear. The audits that most people fear are these in-person audits where an auditor will come out and audit your individual or place of business. Assuming that there's no fraud involved, the IRS can audit a return for the latter of either 3 years from the date of the return, when it was filed, or the due date, whichever came later. So if you filed for an extension and then turned it in with that extension, or then turned in your return late, the actual time that it was filed or the due date, whichever one is later, will be the time when the statute of limitations will start to run. Fraud, basically, there's no statute of limitations. So if you were fraudulent in preparing your return, you can get nailed for that for the rest of your life. So that's a good motivation not to be fraudulent. Also, if by accident you understated your gross income by 25% or more, that's basically considered gross negligence. And so you'll also have a longer statute of limitations in that case. These are, again, this flowchart doesn't really help you that much. These are the different types of penalties that you could have. FTF means failure to file. FTP is failure to pay. Fraud, obviously, is self-explanatory. And then accuracy-related penalties. That would be more or less if you accidentally filed an inaccurate return. Interest and penalties can accrue differently based on the type of mistakes or errors that were made. A failure to file penalty can be 5% per month up to a maximum of 25%. Failure to pay would be if you filed your taxes but owed money and did not pay that money. That would be a failure to pay penalty, and again can be up to 25% of unpaid liability on top of having to pay that liability, and that accrues at the rate of 0.5% per month. Interest accrues both on the unpaid liability and the penalties, so whatever the prevailing rate of interest is at the time will be tacked on to any unpaid liability and the penalties as they're accrued. You can have a 25 or a 20% accuracy related penalty. This is if it's just an accident, and then up to 75% penalty for fraud. Taxpayers do have the ability to appeal if there's a field or office audit, and that can be appealed through the tax court system. These are the various components of tax practice. This is how you can be paid to be a tax professional. You can work as a tax compliance person. This is what you would be working as if you worked for the IRS as an auditor. You would be working in tax compliance, making sure that people are complying with tax regulations. You can be a tax researcher. This is either an academic, such as myself, who teaches and researches tax, or you could work for a company that does this and provides tax information to users of that information. You can work in a tax planning and consulting firm where you are helping develop a plan for minimizing tax-related payments, and financial planning is related to that, but in a more broad sense, if you're an overall financial planner, obviously planning for tax-related payments is a component of that as well. So, due to the nature of the fact that taxes can be very complicated, working in tax can also pay very well. Tax lawyers, if you work for a big tax firm, can make a lot of money. Tax accountants can make a lot of money. Tax planners and consultants can make a lot of money. And, you know, as in most things in life, the level to which most people detest what you are doing is often the same level of compensation that you can get for it. Obviously, you know, working as a professional athlete pays very well because not very many people can do it. Working as a tax accountant can pay very well because A, not very many people can do it because it can be very complicated, but B, not very many people want to do it. So if you are that special individual that enjoys doing this type of work, it can be very lucrative, and you can maximize that benefit that you have in your life. Okay, we'll go from there, and that's where we will pick up when we meet next in class.